Hello and welcome. Bulgaria is on course to switch from lev to euros next year. First, a few basic points. All EU member states, except Denmark, are required to eventually switch to the euro. Bulgaria, in practice, signed up to the euro when it joined the European Union in 2007. The national currency, the lev, was pegged to the Deutsche Mark, and when Germany switched to the euro, the lev was pegged to the euro. And in 2020, Bulgaria entered the ERM II, formally. But de facto, the national currency was already linked to the euro. The currency exchange rate is BGN or lev 1.95583 for €1. The exchange rate mechanism, or ERM, was set up to stabilize exchange rates among the EU member states in preparation for the launch of the single currency. After the replacement of national currencies with the euro, the ERM was upgraded to ERM II. In ERM II, the exchange rates are fixed. The European Central Bank, ECB, is in charge of monetary policy, and the ERM sets out also a path for EU member states they joined after the introduction of the euro to adopt a single currency. After 2 years in the ERM II, the country can apply to have its readiness for the euro evaluated. The readiness of a country to adopt the euro is evaluated on a set of convergence criteria. Price stability. Average inflation rate should not exceed by more than 1.5 percentage points the average inflation rate in the 3 best performing member states. Sound public finances. Budget deficit should not exceed 3% of GDP. Government debt should not exceed 60% of GDP. Exchange rate stability, which means no devaluing against the euro. Long-term interest rates as a measure of economic sustainability. The average national long-term interest rate as measured by 10-year government bond yields denominated in the national currency over a 1-year period prior to the assessment should not exceed by more than 2 percentage points the average of the 3 best performing members. As it stands, Bulgaria has met the above criteria and, if there are no objections put forward by other member states, Bulgaria will go euro next year. The basics out of the way, it is time to look at this situation in Bulgaria. Opinion polls in 2022 reported widespread concerns among Bulgarians about switching to the euro. The Eurobarometer surveys have nicer numbers, but the results do not show great support for the euro in the country. The government has issued instructions, guidelines, and set up working groups to manage the switch. Private and public institutions must cover their own costs arising from the introduction of the euro. Euro and lev will both be accepted for 6 months after launch, and during this period, leva will be exchanged for euros free of charge. Dual price display will be mandatory for 12 months after the EU Council formally accepts Bulgaria into the Eurozone. The government has set up a number of working groups to help financial and non-financial institutions and businesses through the transitions, and to help protect citizens, minimize the risk of fraud and unfair pricing, and is developing a process to identify and fine businesses that do not apply the correct conversion rate rounded to 2 decimal places in the pricing from lev to euros. And there is a roadmap for an intense information and education campaigns, with the intent of dispel fears and quell anxieties about the euro among Bulgarians. So, is everybody happy and relaxed? Of course not. My media feeds are full of very worried and angry people. One of the main concerns is that the euro will result in price increases. And to discuss this point, I take my inspiration from a paper by Giovanni Mastrobuoni at Princeton University. Giovanni Mastrobuoni notes that the euro was launched on January 1, 1999 as an electronic currency, and exchange rates were fixed then. On the 1st of January 2002, the euro became legal tender. It was assumed that the prices may adjust slightly, but there was no reason to observe a significant increase in actual and perceived inflation. In reality, most Europeans felt that the introduction of the euro triggered price increases, which led to a widening gap between perceived and actual inflation. My takeaway from Mastrobuoni's paper is that people judge price increases mostly on goods they buy most often, and these tend to be low-price goods. And the perception of inflation is higher for people that tend to convert the euro prices into the old currency prices, and then compare the remembered old price to the new price. This behavior opens up the door to rounding errors, errors in price recall, and, interestingly, the time spent doing these calculations also becomes a cost. For example, as I find myself checking the price in euros against the price in leva, I become more aware of prices, especially for small ticket items. And, as in the past, I have tended to spend more time looking at products that I think are expensive for what they are, that may leave a lingering feeling that things in general are more expensive than expected. If you add into the mix the natural progression of inflation, this can create a perception of price hikes. Having said all that, I would argue that there are real costs for any business in transitioning to a new currency, and depending on the size of the business, these costs may take up a higher percentage of their turnover. The fixed costs of the changeover will be proportionally lower for large businesses than for small businesses. Moreover, large businesses are more likely to benefit from the disappearance of currency exchange costs than smaller, Bulgaria-focused businesses. In any scenario, it is unlikely that these costs will not be eventually passed on to consumers. But the spread between real and perceived inflation should fade as the country as a whole gets used to operating in euros, seems to be Mastrobuoni's conclusion. But the euro is not a lonely rider. It is often flanked by credit boom, real estate price hikes, and services price hikes, which are closely followed by social tension and political instability. And here I repurpose a paper by the OECD, the Under Pressure, the Squeezed Middle Class. Adoption of the euro generally opens up the credit market. Borrowing becomes easier and less expensive. A credit boom can mimic growth and create the illusion of wealth. Unfortunately, the other side of a credit boom is a rise in household debt. Availability of easy credit generally results in price hikes in the housing market. People can borrow more money to buy the home of their dreams, and as housing stock is limited, prices tend to go up. The cost of services ranging from beauty, health, education all tend to go up, along with the introduction of the euro. And now for the middle-income class. The middle-class lifestyle is typically associated with certain goods and services and living conditions, such as decent housing, good education, and good and accessible health services, a good standard of personal grooming and apparel. While middle-class incomes have barely grown and in some countries stagnated for about 3 decades, the cost of the middle-class lifestyle, especially housing, have risen well above inflation. Among middle-class households, there is now a growing discontent with economic conditions. The middle class in Europe, on average, counts for more than 60% of a country's population. In this context, the stagnation of the middle-class living standards in OECD countries has been accompanied in recent years by the emergence of new forms of nationalism, isolationism, populism, and protectionism. Nationalistic and anti-globalization sentiments can arise because a shrinking middle class produces disillusionment with the political class and may turn voters towards anti-establishment parties. All of these, in turn, create social tensions and feeds into political instability. There are risks as well as rewards connected to the adoption of the euro. Some of the risks and downsides are not, technically speaking, connected or caused by the euro, like the decline of the middle class in Europe, for example, but because in people's mind a change of currency is a watershed moment, any negative experiences that might follow the event or are put in sharp focus by that event, like the decline in the middle class income, will end up being associated with it, in my opinion. The government and the Bulgarian National Bank are positive that Bulgaria will flourish. Eurosceptic parties are positive that the euro will sink Bulgaria. I think that the most likely scenario is somewhere in between. Some will benefit more than others, and this may feed feelings of unfair access to resources and distribution of economic rewards. With regards to political instability, Eurosceptic parties have been gaining a few more votes at every election, of which there have been 7 in 4 years. The average voters' turnout for parliamentary election is just shy of 40%. Each election has returned a fragmented parliament, which has resulted in not very stable coalition governments, and at least once a government could not be formed and the country had to go to the polls again. The old guard, namely GERB, is steering the ship. Interestingly, a number of parties, generally at loggerheads with each other, have sort of joined forces in the push for the euro. But there is a risk that once the future of Bulgaria in the eurozone is assured, the government may fall, which is unfortunate, as it would be better to have a stable government at the helm of the country during the adjustment period, which can be quite rough. Well done for making it to the end. Thank you for watching. All the links to the sources I've used are listed below. Have a lovely day. Bye bye.